Whether you're prepping for a strategy meeting, looking to launch a startup, or just, insanely curious about where the money is flowing in 2026, this deep dive is for you.
Absolutely.
Because we found a pretty crazy stat. A 55-year-old scrolling Facebook is now statistically more likely to impulse buy a product from an influencer than a Gen Z teenager on TikTok.
Which is wild.
Right. So today we are tearing down a massive stack of 2026 business intelligence reports, market guides, and financial blueprints. And our mission here is to extract the absolute most viable, proven paths to generating serious revenue. Specifically, we're looking for models with proven pathways to $1 million or more in annual revenue.
Yeah, and establishing that premise is so important. Building $1 million business in 2026, it isn't about finding some secret hack. It's really about choosing the right model, executing relentlessly, and just understanding the data.
Exactly.
So we are going to look at 3 distinct arenas today. We've got high-margin digital software, consumer-facing market hacks, and massive enterprise-level consulting and compliance trends.
So to understand where the highest margins are today, we really have to start with the digital bedrock, right? Which is software as a service, or SaaS, and mobile apps.
Yeah, SaaS is still highlighted in all these reports as the ultimate wealth creation model. I mean, we're talking about businesses boasting 70 to 85% gross margins.
Oh, wow.
Yeah, and they're trading at 8 to 15 times revenue multiples. But the landscape has fundamentally shifted.
Because of AI.
Exactly. The sources show that 92% of SaaS companies are now integrating AI. But the crucial difference in 2026 is whether a product is AI native versus just AI enhanced.
Okay, let's unpack this.
Yeah.
Because adding AI to a clunky software product, it's kind of like taping a rocket booster to a bicycle, right?
That's a great way to put it.
Like, sure, it's AI enhanced, but it's going to crash.
Yeah.
AI native means the AI is the engine itself.
Right. And if you're not AI native, you're just facing a massive crisis right now, especially with app growth. The data shows that 60 to 70% of users drop off in the first 24 hours.
That is brutal. Everyone talks about getting new users, but aren't we just pouring water into a leaky bucket if our retention is terrible?
Yes, exactly. And what's fascinating here is that the data completely backs that up. The solution isn't pouring more money into marketing, it's fixing your onboarding.
Right.
The reports indicate that just a 10-point improvement in onboarding can essentially double your effective customer acquisition cost, or CAC.
Well, let's run that math, because it really paints the picture. Say you're spending $10,000 to acquire 1,000 users. Your theoretical CAC is $10.
Right?
But if your onboarding is so poorly designed that 800 of those users churn by Tuesday.
Which is very common, sadly.
Yeah, it happens all the time.
Yeah.
You actually spent $10,000 to acquire 200 retained users. So your effective CAC is now $50.
Exactly.
But if you fix the onboarding so that 400 users stick around, it immediately drops your effective CAC back down to $25. You're altering the unit economics without spending an extra dime on ads.
And that math right there is the key to survival. The reports make it clear that your net revenue retention, your NRR, needs to be above 100%, and your SAC payback period must be under 12 months.
Right.
And because of those economics, remarketing share of app marketing spend has actually risen to 29%.
Oh, really?
Yeah, because reactivating dormant users has vastly better unit economics than buying brand new ones. The whole focus has shifted entirely from just acquisition to the LTV to CAC ratio lifetime value compared to customer acquisition cost.
Okay, so that's the digital software side. But what if you aren't a software developer?
Right.
If we step out of the tech stack and look at consumer behavior, there are these massive opportunities to build million-dollar businesses by intercepting people where they already hang out, or leveraging physical assets you don't even own.
Absolutely. Social commerce is a perfect example. The global social commerce market is sitting at $2.6 trillion.
Trillion with a T.
With a T.
Yeah.
And the U.S. makes up $126.6 billion of that. Plus, 64% of the global population is on social media now.
And the reports mention this concept of ambient shopping taking over.
Yeah, ambient shopping. It basically means people are buying things while they're doing something else. Like 69% of shoppers buy things while multitasking. They're scrolling TikTok or watching Netflix, and the store just comes to them.
Right. And here is a crazy stat from the sources. A staggering 94% of U.S. social media users buy from Amazon after seeing a product via an influencer.
That is a massive conversion rate.
It is. And surprisingly, like we mentioned at the start of the deep dive, The 45 to 60 age group is the most influenced at 97%.
Which is so counterintuitive.
Totally. And Facebook Shops currently lead the US with 280 million monthly users. It's just this incredibly frictionless environment.
And that lack of friction is everything. Because whether it's an impulse buy on a Facebook shop or booking a property on Airbnb, the barrier to entry for the consumer has basically vanished.
Which brings us to the Airbnb rental arbitrage model,
Yeah.
generating 50 to 200% annual returns without even owning the property.
Right, the startup costs are incredibly low. You're looking at maybe $8K to $15K compared to a $40,000 to $80,000 down payment for traditional real estate.
Here's where it gets really interesting. This arbitrage model is essentially digital real estate flipping.
Huh?
You're renting the physical structure, but you own the income stream.
Exactly. The strategy laid out here is you form an LLC, you secure a commercial lease with explicit written permission to sublet, and you aim for a 1.5x to 2x revenue to rent ratio.
Right.
And a popular way to do this is the premium rent model, where you actually offer landlords 10 to 20% above market rate just to get that permission.
But, I mean, this raises an important question about risk versus reward. Because while the startup capital is incredibly low, and you bypass personal credit barriers by using an LLC.
You build zero equity.
Right, zero equity. And you are entirely at the mercy of lease renewals and local regulations.
Yeah, it's a huge vulnerability. Both the social commerce and the arbitrage models rely entirely on those frictionless environments staying open.
Okay, so we've explored the developer's path and the consumer hustler's path. But we really need to look at the macro level, too.
The big enterprise shifts.
Exactly. Where are the Fortune 500 companies directing their massive budgets in 2026? And the sources point to two major arenas: AI strategic consulting and carbon credit compliance.
Yeah, the AI consulting boom is wild right now. The BCG 2026 Radar report shows that CEOs are doubling their AI spending. They're going from 0.8% to 1.7% of revenue.
Which is billions of dollars.
Tens of billions. The AI consulting market is hitting the low to mid-teens of billions of dollars because enterprises are just desperate for help moving from these little pilot programs to scaled AI agents.
Right. They need help navigating the governance and avoiding massive AI scandals.
Exactly. Nobody wants an autonomous AI agent to accidentally sign a bad contract or leak data.
So what does this all mean? I mean, are these massive corporations just throwing billions at consultants and carbon credits for good PR? Or is there a structural shift happening here?
Well, if we connect this to the bigger picture, we see that these are not discretionary PR budgets. These are existential survival budgets.
Oh, wow.
Survival? Absolutely. Let's look at carbon credits. Budgeting for carbon credits in 2026 is wildly complex. You can't just look at current spot prices or generic inflation anymore.
Right. The reports were very clear that prices vary drastically.
Huge variations, like top-tier, AAA-rated ARR projects, which stands for afforestation, reforestation, and revegetation. They command $10 more per rating band.
And geography matters heavily too, right?
Oh, massively.
Wow.
African ARR projects trade at $37 a ton. But in Asia, similar projects trade at $14 a ton.
That is a massive spread.
It is, because securing high-quality, compliance-eligible carbon credits before the supply tightens is a top-tier risk mitigation strategy. Impending compliance standards like CORSIA are scaling up rapidly.
So organizations are forced to use scenario-based budget planning like low, medium, and high demand models.
Exactly. Companies are basically paying premiums for certainty in a very uncertain 2026 landscape. Navigating complex generative AI ecosystems safely and securing verified carbon credits, it's just the cost of doing business now.
Yeah, so to synthesize all this and bring it back to you, the listener, whether you are a solo entrepreneur looking to bootstrap an AI-native SaaS, or a marketer tapping into the $126 billion ambient shopping trend, or even an executive trying to forecast carbon compliance, the rules of 2026 are clear.
Very clear.
You have to retain your users, leverage assets efficiently, and anticipate market complexity. But remember, knowledge is only valuable when applied. So we really encourage you to look at your own projects through these specific economic lenses.
Definitely. And I just want to leave you with a final lingering idea to chew on.
Sure.
We just spent this entire deep dive exploring how humans can build wealth by navigating AI software, carbon markets, and rental arbitrage. But what happens in the very near future when autonomous AI agents start doing the ambient shopping? Or what happens when an AI negotiates your Airbnb master leases for you? Or starts trading those 37 per ton carbon credits on behalf of corporations?
Right.
When the software becomes the buyer, how does that rewrite the $1 million business playbook?
That is a fascinating question, and definitely something to mull over as we wrap up this deep dive. Thanks for listening, everyone.